Welcome back to A to Z Equities, where we cover all US listed stocks from A to Z. Today we'll be covering AAON Inc., ticker AAON. Starting as always with industry, then moving on to price, growth, financial position, and management. We'll be awarding a 1 to 5 star rating in each category. And at the conclusion of the video, we will be providing a blended total averaged 1 to 5 star rating for this company. Starting with industry, looking at the investor relations page here, we see a lot of different metrics provided to investors, as is fairly typical for an investor relations page. We don't really see any information here on what the company does that will be helpful in terms of giving it a rating for industry. So let's move on to its Wikipedia page. AAON manufactures heating, ventilation, and air conditioning equipment for commercial and industrial indoor environments. So this is a commercial and industrial HVAC equipment manufacturer. The company got its start in 1988. And what we see here is that AAON is in a fairly stable industry. Commercial HVAC, definitely not an industry whose demand is going away. Strikes me as an industry that's probably not cyclical at all. It's probably a pretty stable growth industry, inflation resistant, all that good stuff. And especially potentially heading into a recession, a lot of chatter about that. This is a company that its services are going to be needed regardless of anything that might be going on in the world. HVAC is not really a negotiable asset or a negotiable investment for businesses to make, or individuals for that matter, but particularly businesses in this case. And so we're going to give AAON a really good 4 star score for industry. Moving on to price, let's take a look at AAON's financials here on Seeking Alpha. And before we dive into the price metrics, as always, we just got to take a look at what the company's price is here. So the market cap is 6.95 billion, fairly large company. It's a mid-cap company, about a $7 billion valuation. And so that's going to be the price numerator that's going to go into all of our price ratios. So price to earnings, price to sales, we're going to be dividing this price, the 6.95 billion, by each of those metrics as we go through the financials. So let's take a look at the income statement here, starting with revenues. And we see that revenues for the trailing 12 months are about 1.2 billion. So we're going to divide our price, which again is 6.95 billion, by the revenues, which are 1.194 billion, and we get a price to sales ratio of 5.8 on a trailing 12 months basis. 5.8 is a pretty high price to sales ratio. That's a pretty premium valuation as compared to sales, especially considering that we see here the gross profit is good. It's 433 million here. That's probably 35% or so, maybe a little more of the revenues. However, nothing extremely special in terms of gross margins, that would seem to warrant such a high price to sales ratio. So definitely a bit of a premium valuation. And moving down here to net income, we see net income is 186.4 million. So we're going to divide again our approximately $7 billion market cap by 186.4 million. And we get a price to earnings ratio of about 37. So we have a price to earnings ratio on this company of 37.3 to be precise. And again, that's kind of rich, a bit of a rich valuation here. And we're going to have to see later on in this analysis whether this company can justify that. But as of now, looking a little bit pricey, definitely a profitable company, but still looking a little bit pricey on the basis of its earnings as compared to its price. Moving over to the cash flow statement, scrolling down here, levered free cash flow in the trailing 12-month period of 84.8 million. So again, we're going to divide our market cap by our free cash flows, and we get a very lofty price to free cash flow ratio of 82. So this company trades at definitely a high valuation. We also see that this free cash flow of 85 million approximately is significantly higher than it's looks like it's ever been before. And so that's not like an aberration where the last 12 months had low free cash flow. This is actually quite high free cash flow. Even so, the company is trading at 82 times this free cash flow. So definitely looking like a high priced company, not looking like a company that's going to get a very positive score in the price category. But of course, as we move on to other categories, such as growth and financial position, maybe it will get better scores there. You definitely expect a company that is trading at such a high price versus its earnings to be putting up solid growth. So we'll see if that's the case. Now, looking at the balance sheet, we're going to want to compare again the price of the company, that $7 billion valuation, to any book value that the company has, meaning any assets minus liabilities. So definitely positive book value here, 740.5 million currently. So let's divide our $6.95 billion market cap by 740.5 million in book value, and we get a price to book ratio of 9.4. So this company is trading at 9.4 times its book value. I mean, it's good that there's a positive book value here for sure, but at the same time, that's not going to offer a margin of safety relative to the price. And quickly, let's just take a look at tangible book value as well. Tangible book value here is a little bit lower than the book value, as it usually is, at 583 million, and so we get a price to tangible book value ratio of 11.9. Again, pretty pricey. Of course, it's good that this company has positive book value, positive tangible book value. That's very positive. A lot of companies have negative book value, especially negative tangible book value. This company has positive net assets on its balance sheet, but the price is pretty elevated relative to those assets. So those assets don't really provide a margin of safety. And now this is going to help out the company more when it comes to its financial position. The fact that it looks like a pretty good balance sheet, and we'll get into that. But as of right now, on the price front, it's not looking so attractive. Again, the price to sales ratio was close to 6, price to earnings was high 30s, price to free cash flow was in the 80s, price to book value, price to tangible book value around 10. So on the price front, again, it's good that none of these ratios are negative, so that's going to help out the company a little bit. But at the same time, I don't think we can really give the company more than a 2 on the price front. 2 stars out of 5 on the price front is what they're going to get. And so moving on now to growth, and we're going to be looking at some of the same metrics that we were just looking at in terms of price, but we'll be focusing more on the long term trend. And so going back to the income statement, looking at the revenues here, we see very, very solid revenue growth. So going all the way back a decade, they were in the mid 300s, around 350 million in annual revenue. And obviously that's ballooned. And that growth rate has accelerated because if you look at 2021, they were up to 534.5 million. That's already solid growth over the prior 5 years or so. But then in 2022, a massive jump to 888 million. A nice jump after that last year to 1.17 billion, and now still ticking higher in the current year. On a trailing basis, they're at 1.194 billion. So that's really, really good growth. Let's see if the net income has similar growth, and we see that it does. It's ballooned over the last decade from around 45 million a year to 186.4 million, still going up quite rapidly. Looks like only a couple of declines here. A small decline in 2018, a small decline in 2021. Other than that, just been marching higher. And these growth numbers look really good and maybe give us a bit of a sense of how this company is justifying such an elevated valuation. So let's move over to the cash flow statement and see whether the cash flow growth similarly reflects that trend, and we see that it does for the most part, although they did have a negative free cash flow in 2021. That could be for any number of reasons. And it's not necessarily something that reflects unfavorably on the company. We see that it's trailing 12-month free cash flow is significantly higher than it's ever been before. Definitely a growth trend here, an inconsistent growth trend, but overall a growth trend. And It gets extra points for the fact that the trailing 12-month free cash flow this year in 2024, clearly they've been doing a really, really good number on free cash flow. And so that's going to help them out as well. And then lastly, let's see what the analysts are expecting in terms of future growth. So let's go to earnings estimates and see what the analysts are saying. For this year, earnings growth is expected to be around 2%. Next year, 23.6. The year after that, 24.6. And so a really, really solid growth story here in terms of what analysts are expecting, a continuation of the company's prior growth trends. On revenue as well, mid single digit growth expected next year and the following year in 2026. Only one analyst here in 2026 is making a projection, but the point being, we see very, very solid growth. So, on the growth front, this company is going to get 4.5 stars. There are better companies out there in terms of growth. There are companies with higher growth, and so that's why it's not going to get 5, but 4.5 stars, really, really good rating on this metric for AAON. Very good. Now, moving on to financial position, let's take a look back at the balance sheet. And we're going to be looking at a few different metrics here to see how this company is doing. It looks like they have very, very little cash. That's surprising, but they have a couple hundred million in receivables here, 423 million in current assets, and current liabilities are a fraction of that at 141 million. So that's a current ratio of around 3. You have current assets at around 3 times current liabilities. That is a fantastic ratio, much stronger than we could reasonably expect to see for any company. If we look at the long term debt, if we scroll down, they have a pretty small amount of long term debt. It's been building a little bit from 2021. This is tiny relative to the market cap. We're talking about a $7 billion company. They have 85.9 million in long term debt. That's negligible, and it doesn't really add anything to the enterprise value. So that is another really good number for this company. The long-term debt is also not much higher than the earnings if we take a look at the income statement. So again, we have 85.9 million in long-term debt. We have a similar amount in cash flow if you recall in the trailing 12-month period, but let's also see about net income. Again, net income 186.4 million. That is more than double their total long-term debt. So in a single year's earnings, out of a single year's earnings, they could easily pay off their debt and then some. That debt is negligible as compared to this company's earnings power. And then let's just see about interest expense. Again, a fractional amount, less than $3 million on a little over 80 million in debt. That's a very low interest rate, low single digits. And that is befitting because this company is in a very, very strong financial position. And so for financial position, this company is going to get another 4.5 rating. And so let's move on to management then. And we're going to take a look at a few different metrics to rate this management team. Management is a really tough thing to rate. We're not looking at their resumes, we're not looking at their experience or qualifications because all that stuff is very subjective. We're going to focus a little bit more on objective metrics. This is a very unscientific endeavor trying to rate this management team, but it's still important, and we're going to try to do it in as an objective way as possible. So, going over to earnings, let's see about how this company is doing relative to analyst estimates. So, we see a pretty middling record here, pretty mediocre. On earnings, they've beat 5 times in the last 8 quarters, missed 3 times. Revenue, they've beat and missed 4 times each in the last 8 quarters. So, that's not going to really help them out much in terms of the management team because they're not doing such a good job at managing analyst expectations. We do like to see management teams undersell their companies and then over deliver. So that's not really the picture that we're getting from the last 2 years of analyst estimates versus the eventual results. Now, let's take a look over at insider transactions. We see here on bar chart, last 3 months, management insiders have sold a little over 71,000 shares, bought zero on the open market. Last 6 months, they've sold over 191,000, bought zero. And in the last 12 months, purchase of 500 shares, but that is very, very vastly offset, 1,000 to 1 by the 506,000 shares sold. So that's not something that's going to weigh in favor of this company. It is often said management teams sell shares for many reasons. And, maybe a director needs a new house, a new swimming pool, a new car, pay off a medical bill, whatever it is. But at the same time, it's not a trend that we like to see where there's no insider buying or negligible inside buying versus large scale insider selling, which is what we're seeing here. That could indicate that the insiders are not so optimistic about the company, or at least think that the company is overvalued at its present levels. I'm not saying that's the case. Again, there are many reasons that management sells shares, but at the same time, it could be the case, and this could be an indicator that that's the case. So, lastly, let's just take a look at what the company's share count has been doing. So, we go back to the financials and scroll down here on the income statement, we're going to be looking for the diluted share count. So we see that here. We see that the share count is ticking up slightly. It did tick down from 2014 to 2016, 2017, 2018, 2019. It remains stable, and then it starts ticking up again very slowly. Now back up to 83.3 million. Not a huge growth in the share count. So there's little wrong there. We'll look on the cash flow statement to see what stock-based compensation looks like. So how much management is being compensated in shares, and we see it's a pretty small amount. 17 million in the trailing 12 months. Not too bad. It is a bit of an uptick from prior years, but really not too bad relative to the size of this company. 17 million is kind of a rounding error. And so, again, in terms of the performance versus forecasts, middle of the road, beating about half the time, missing about half the time. Insider transactions not looking so good. Share count looking fine. The share count is looking fine. Stock based compensation, not bad. So, we're going to give the management team, I'm debating between 2.5 and 3 stars. I think we'll go with 2.5 based on the large volume of share sales and the forecast, versus the actual earnings. So I think we'll round down on this one, go to 2.5 stars. So to recap the scores here, we have AAON scoring a 4 for industry, a 2 for price, 4.5 for growth, 4.5 for financial position, and 2.5 for management. That gives us an average score of 3.5 stars. So that's the score for AAON. 3.5 stars, a very respectable score, largely on the back of very strong growth, very strong financial position, points coming off the board, mainly for price, also for management a bit. 3.5 stars for AAO, and again, a really, really good score. This is not financial advice, to be clear, not a buy or sell recommendation for this stock. You should do your own research. This is a very surface level overview of a few key metrics. Hopefully, it's helpful in terms of both enhancing understanding about this company as well as how to value companies in general. Again, just on a really surface level. Really appreciate you tuning in to A to Z Equities. We hope to see you back on another video really soon.